when it comes down to investing in a company, you can either invest as a shareholder by buying a piece of the equity, or you can invest as a creditor by holding a corporate bond issued by the company. As a shareholder, you have a right to receive a stream of variable dividends, and theoretically, you have unlimited upside. As a creditor, you are entitled to a series of fixed coupons, and hopefully, you get your capital back at the expiry of the bond. Also, as a creditor, you have senior claims on the assets and the cash flow of the company. Since the outbreak of the financial crisis in 2007, the creditor has been the clear winner, as evidenced by the vast outperformance of global corporate bonds compared to global equity markets. Until recently, companies had to pay a relatively high coupon to refinance their debt, and as a consequence, a large portion of the economic profit went to the creditor. Recently, the corporate bond yield have come down sharply from 5% to 3%, and companies have no problem to issue debt at a low level. What does it mean? It means that if you assume global economic conditions to improve further, which is our central assumption, then going forward, a growing portion of the economic profit will go back to the shareholder. And all in all, if you make a comparative analysis, we believe that going forward, it is better to be a shareholder than a creditor. Going back to markets, the US economy, despite unresolved fiscal issues, is showing good resilience. And we expect the economy to surprise in the second half, thanks to an ongoing boom in the energy sector and a continued recovery in domestic housing. Economic prospects in the Eurozone are at least stabilizing, and recent indicators confirmed a pickup in the Chinese economy. With the support of central banks and reassuring corporate earnings, one could expect a continuation of the very positive trend that we have observed over the last 2 months. However, equity markets are overbought, and investor sentiment has reached bullish levels, which historically have led to consolidation. This is the reason why we have bought a put on the S&P 500 to allow for near-term downside protection. In addition, we have further reduced our exposure to safe haven government bonds, putting the money into cash. As investors are scrambling to invest their cash after a strong rally, we are keen to keep our flexibility with a substantial cash balance to be able to deploy the money as opportunities arise. Thank you for your attention.